Good morning. The Bank of Canada raised interest rates for the third consecutive time with their interest rate announcement this morning. They raised rates by 0.5 percentage point, so that's a total of 1.25% in this rate hike cycle. It's also the same total number as we got in 2018, the last time they raised interest rates. Also looking like we're not out of the woods yet. I mean, consensus is still for another 0.5 percentage point jump at their next meeting in July. I know a lot of people, if you're in a variable rate mortgage, you read that, you take that in, and you think, geez, rates are going up. I should not be in a variable. I should lock into a fixed. But you got to keep in mind, it's always a question of what your two options are. Your choice is to stay in your variable rate, lock into a fixed. But if you lock into a fixed, you're going to see an interest rate jump of, around 1.5%, depending on what you're in and what you can lock into. So if you're worried about interest rates going up, if you're worried about higher payments, does it really make sense to realize all of the higher payments and interest rates from day one? I mean, for one, there's no guarantee we're going to get this number of rate hikes. Two, when you lock into a fixed rate mortgage, you're taking on a significantly higher penalty risk. Most people break their mortgage early. The difference in penalty between a variable and a fixed, it's going to be a lot more than the difference in interest between being in a variable rate versus a fixed rate. And further to that, to make the variable more expensive, we not only need to get all those rate increases, but it needs to stay there. The stay there is the key piece. If you look at a history of interest rates in Canada, anytime we've seen these big, sharp increases like we're seeing now, rates tend to fall just as quickly in roughly 12 months after they started raising rates. So, being in a variable rate, it's a situation where, you're in the uncomfortable part of being in a variable, but it's called variable for a reason. It goes up, it goes down. It doesn't tend to go up and stay up. It tends to peak and come back down. And, I think that is worth considering. I wanted to take a step back to put into context. I know a lot of people like to anchor on, economist forecasts of where interest rates are going to go, what the central bank is saying for interest rates, and think that word is gospel. Let's look at what's happened over the last 2 years. So we had the pandemic hit. 2020, Bank of Canada comes out and says, hey, we're not going to raise rates until well into 2023. We're in 2022. We got to March, basically, before they started raising rates. And now look at how much they're raising rates. Got to take that with a grain of salt. They also said, and also, side note, how many people made major financing decisions based on that guidance? Also, throughout the pandemic, we had supply chain disruptions. We had, due to COVID, factories shutting down, logistical issues. So we had a supply shock while we had our federal government flooding the economy with free money. And granted, people needed help during the pandemic, but I think we all heard stories of many, many people who received stimulus, who received free money, who didn't really need it. Businesses that got checks when they didn't really need that help. So we have a surge in demand. We have a supply shock. Of course, we're going to see inflation. And throughout the last 2 years, the Bank of Canada said our intention is to let inflation run hot. Fast forward to the beginning of this year, we're seeing the highest inflation readings we've seen in decades. The Bank of Canada doesn't raise rates at their first meeting, and then in March they start jumping to, raising rates, and now we're looking at 50 basis point hikes. So it's like, who's driving this bus? We granted there's still more rate hikes being priced in towards the end of this year, but again, these are the same people who were calling for no rate hikes in 2023. You got to take this stuff with a grain of salt. There's an old saying, I think I've said it on these videos before, the cure for high prices is high prices, meaning when the cost of goods goes up, when inflation is running hot, when mortgage rates have doubled basically in 6 months, there's demand destruction. High prices take away from the free cash that we have to spend on all the other things that we like to spend on in the economy. We're starting to see that. I mean, Q1 GDP number for Canada came in well below expected. It came in at 3.1%, which is still a healthy number, but Q4 was over 6%. So on a rate of change basis, growth is already slowing. And Q1, we didn't even really see that much of an increase in interest rates. So quarters moving forward, I mean, growth is certainly going to be impacted. It's going to be an interesting year, but I think, again, if you're in a variable rate mortgage, it's going to be uncomfortable. You just got to remember a recession is coming. It's not a question of if, it's a question of when. And that is what we'll find out. Thanks for watching. If you have any questions, feel free to get in touch and we'll talk to you later.